Hello and welcome to a brand new episode of ET Markets AIF Talk, a show where we discuss opportunities as well as investment strategies deployed by the fund managers in the popular space of ultra HNI investing. Well, my name is Shatajan, and today we have with us a very special guest, Mrinal Singh, who is the CEO and CIO at InCred Asset Management, who manages over $100 million in AUM. Welcome to the show, Mrinal.
Thanks, Shatajan. It's always a pleasure.
Thank you so much for being part of this segment, Mrinal. Now, your India Value as well as Growth Fund as well as Emerging Business Fund have created impressive alpha since inception. Now, take us through the one-year performance of the fund as well.
Well, the IVGF has completed more than 3 years for us. So by end of May, the CAGR was upwards of 19% for our customers. And EBF is just over a year old. And even in case of EBF, we are, again, on the end of May, we are upwards of 17% CAGR. Now, both the portfolios have different objectives. In fact, the investment style is different. It is to a large degree governed at the point they were launched and how the market presented itself at that juncture. The IVGF is more GARP oriented, wherein the EBF is a more value bent of approach. And so the portfolio compositions are different as well from each other. In fact, two different portfolio managers manage that. And we believe in practicing the right investment style and stock picking approach. And obviously, it's backed by intensive research and portfolio management skills. The intent is to deliver alpha and a great customer experience over a long period of time. Now, two different styles and approaches also signify recognition on our part.
Yes.
That there can be multiple successful investing styles based on how the market is presenting itself at that juncture. So we're not one of those who believe that X investment style is better than Y or Z. We think that all legitimate investment styles have a fair chance of doing well as long as we deploy them at the right time in the right phase of the market. So that's what the investing in these two products is about.
Definitely, we'll talk about both these funds individually as well. Now, let me go to the IVGF fund first. That is the India Value and the Growth Fund. So how do you pick stocks under this strategy?
So it's a very classical approach and obviously bottom up. We generally construct. So what is common across portfolios is that the portfolio construction is very, very bottom up. We tend to, in IVGF in particular, as I said, the GARP orientation is heavy. Selecting good management and good business and good valuation in that sequence. So that is how we go about it. So we tend to look for good management. Very often we find more interesting prices in the small and mid cap space, but that's not a necessity. But that's where we end up drifting if we find interesting price and valuation. And it obviously requires more effort to evaluate those managements and businesses. So the good management, good business, and good valuation in that order, ideally. We are not necessarily based on index constituents. So, when we kind of do that, so if practiced in a judicious way, so our fund management expertise is in excess of 100 years at the company level. All the three portfolio managers that manage clients' portfolio have 20 years plus experience each, plus research team. So, if judiciously practiced in a bottom-up fashion and deviating from the index, it creates outsized alpha for long term. Now, that's what we're here to deliver. In IVGF, we continue to refine our positioning to meet the challenges of today in the marketplace. A lot is happening on the fault lines, be it geopolitics, be it commodities, be it inflation and interest rates. And we continue to maintain high conviction in companies we own from a long-term perspective. We've also increased the level of concentration of the portfolio because we found the conviction has to be backed with more allocation. And our top 10 holdings account for more than 50% of the portfolio and out of the top 10 stocks in the portfolio, almost 40% plus is in the small and mid cap space. And that's not by design, but that is where we've drifted in our whole endeavor to keep finding the right kind of stocks for the parameters that I just talked about. And we kind of at this juncture have more small and mid cap preference compared to the large cap. And that's primarily driven by valuation differences that we see across the spectrum.
Right. Now, how about the Emerging Business Fund? And is the strategy different from the IVGF?
Oh, yes. So very, very different. In fact, the portfolio is different as well. As I mentioned before, the EBF, as we call, was launched somewhere in March last year, and we saw the market drift down in that zone. And we think the value orientation of investing style was best placed for such a market. So clearly, EBF is value oriented, and we have our portfolio selection and the stocks coming out from that. Again, although it is bottom up, but it does reflect the higher volatility and uncertainty that is hallmark of such a phase. We continue to be in a phase where higher volatility remains, and that's exactly the kind of hunting ground where value stocks or value managers do well. So, which is what we've done. The not so good data of high inflation seemingly has kind of drifted down. Hopefully, it will keep trending down. But in particular, we look for companies in EBF that are on a path to establish themselves as with large manufacturing base. So we believe that manufacturing and capex is going to be a large driver of incremental growth for the next 5 years, maybe beyond. And that is where the focus has been. We tend to look for balance sheets which are in control, their capability to deploy money and capital for expanding incremental demands in terms of capacity creation, execution skills. Having access to capital or having capital does not mean you can execute well. So a track record over there and leadership in a respective category. And ability to think big. Very often I see a lot of promoters they kind of think small. So we nudge them, that you are thinking too small. The ability to think big, execute, and deploy. So I think that's what the right thing is.
No, absolutely. And in fact, all the big things are first thought in the mind, and then it comes into reality second. Now, if you talk about markets, now we've seen Sensex touching fresh record highs last week, as well as we've seen fresh closing highs for the markets as well. But yes, there's some bit of nervousness around about that time. So what is your sense that you're making from the markets?
Yeah, so we think that new benchmarks would be breached by Sensex and Nifty over the next 3-5 years. That's natural. We've breached maybe the earlier one, but that's okay. That's not something that is surprising to me. But what reality is that we are at an unprecedented path of growth as an economy. Indian economy is very well placed for growth drivers, and it's primarily driven by domestic demand and gains from global supply chain shifts that we've seen. So a lot of supply chain rejig is happening in the world. We had no semiconductor manufacturing base to talk about, and we're talking about significant investment in that space. And the press is full of those announcements. We also are seeing, the PLI scheme having a significant catalyst approach to set up extra capacity, import substitution, and the global customers wanting to outsource more from India. So, and along with that, we think the rural economy, which has been languishing post-COVID, I think it has kind of bottomed out. That's a space, I think, where valuation is very, very favorable. Most investors are kind of avoiding that space because it hasn't done anything well on volume growth. But I think that year 2024 clearly belongs to rural. We already are seeing very interesting signs because the base has compressed, the valuation and expectations have come down. I think there will be sharp responses as things start showing growth over there. And capex-led growth, as I mentioned, continues to drive a host of economic activity. The market is likely to show very divergent set of returns, and it's in fact, even in sectors, we might have a very different set of returns between stocks. So this is a very, very favorable place for bottom-up stock selection. I think earning growth will not be broad-based, and stock selection will become very crucial. Manufacturing obviously is well poised, no doubt about it. But then there are obviously other spots. I think at some point, technology, IT, as we say, will offer very interesting price points to enter. They already have corrected, but I think to me, it looks like the US slowdown or recession, whatever is expected, might not be that long or that deep. So it could be interesting to pick up names there. Healthcare, I think, is underappreciated in terms of what runway and opportunity it offers, but it's also very interesting. And we particularly are seeing, raw material costs coming down makes it very favorable on their margin profile. Monsoon has been slow, at least to begin with. So has been the sowing data. And I hope rainfall will be normal going ahead with the good distribution. So that will have an effect on both rural as well as prices on the food side.
Right. In fact, benchmark indices was sort of a little late in touching record highs, but we saw small and mid caps have really outperformed in the meantime. So how should one play this space, in the second half of 23? Because in the first half, we've seen plenty of action in the small and mid cap space.
Yeah, so that's very valid question, Kshitij. And what is very important to note is, small cap is a very large space.
Absolutely.
By the new definition, the large cap are the top 100 stocks, the mid cap is actually the next 150 stock. So besides the 250 stocks, actually everything else, and there are more than 5,000 listed stock becomes small cap.
Yes.
So even if you see small cap indices, which have 250 stocks or in some cases even more, the divergence that exists between the small cap returns is huge.
Right.
So small cap as a space has become the hunting ground for classical bottom-up investors.
Yeah.
And there will be higher volatility associated with that space. There is obviously less research available. It requires more persistence and temperament. Right. So almost 2 years of tepid returns in small cap. Last 3-4 months, we've seen some uptakes. But I think what really doesn't take away credit from is, if we continue to keep looking for interesting spaces in both small cap and mid cap, largely small cap. It has underperformed large caps by almost 25% in 5 years. So I think that's kind of correcting. Over a long period of time, the data is very favorable for good small cap investing and across geographies. So it's not going to be any different in India. But it obviously requires more expertise, more skill, more time, and more temperament, which is where we think alternate investment managers could have an advantage, because they're dedicated to that space. And then you have to enjoy that journey, which is what fund manager should do ideally. I mean, that's how we would say. So
from small to mid and then large, huh? No, absolutely. Also, I'd like to ask, which sectors are you overweight and underweight on? Although you've picked a few of the sectors in the earlier conversations, but which sectors are you looking at?
So, well, our sectoral allocation are an outcome rather than a desire to begin with. So, but then if you notice, our portfolios our clear preferences are in the space of auto ancillaries and auto.
Right.
We think they are discretionaries which have corrected significantly and are well placed for long-term returns. So is healthcare, industrials clearly for the manufacturing and capex side, some bit of chemicals, technology going ahead. I think could be very, very interesting. Right. And selectively in the consumer durable space as well. We are quite watchful of sectors like financials. It's a heavily owned sector in the marketplace. We need to see how things pan out for them. Housing finance is something that we find interesting. And we strongly believe the next decade, will be a very strong growth for both the Indian economy, and manufacturing will be at the forefront of it. We are also very positive on rural, but that's from we think that rural phase or rural part of the economy has been ignored by the marketplace, and rightly so, because nothing much had happened. But I think that could get corrected. In run up to elections, we've generally seen the rural spending goes up. So it shouldn't be any different in the next 6-12 months. And urban discretionary would typically follow as, more job generation and economic activity picks up.
Absolutely. I think the highlighting factor that you also sort of highlighted is that the 2024 might belong to the rural or, the rural sector or the agri sector. Yeah, if I'm not wrong, because that is something which is actually showing signs of recovery. Yeah. Although, finally, also highlight the risk management practices that you follow, Mrinal.
So I'm quite delighted this question has been posed. It's a very important and relevant question, Kshitij. Very, very rarely do we get to see this question, but that's something as a CIO or a CEO I bother most about. Yeah. Investing is something that we've always done, but these are actually the defining parameters of an investing house. So to specifically answer your question, we've got a very robust risk management practice. It's a blend of process, academia, and experience. So the first layer of sectoral concentrations, stock concentration, liquidity constraints, operational risk, even balance sheet risk and obsolescence disruption risk are something that we take care through process and boundary conditions. You won't be typically crossing 9% or 10% in a stock. Sectoral limits could be XYZ. What is the max order value that you will flow through the system when you're sending it out? and all those things. Liquidity is something that you measure, and all those things. So these are something you can deal with process and boundary conditions. So these are boundary conditions that are put. Besides that, risk like interest rate risk or currency risk are more analyzed when we actually do financial modeling or forecasting, where we use the sensitivity and scenario analysis to see how our outcomes get impacted if we move these parameters, and we try to use the higher margin of safety. So that's part of the research process, essentially. And there are other stock and business specific risks that we take care of, case to case basis. So operational risk, business risk, assumption risk, all those things, we have layers that we try to control. And we're quite happy. We've been quite successful in our outcome with regards to that as well.
Great. Well, on that note, thank you so much for your time, Mrinal. And that's all for now. But do stay log on to etmarkets.com for more on news, business, and economy. Thank you so much for your time, Mrinal.
Thank you. Thanks so much. It's a pleasure.